What's going on YouTube? My name is Matt Fairclough. My company is called the DeRosa Group, and we are a real estate company dedicated to transforming lives through real estate. Entrepreneurs and real estate investors cannot take the majority of Dave Ramsey's advice. Number one factor, all in, is the difference in debt and Dave Ramsey's understanding of debt. And how great would it be to borrow money to buy a revenue stream? That's the way that the wealthy are doing it. By the way, if you like what we do here on this YouTube channel, make sure you like this video and subscribe to this channel and leave a comment. What we're going to talk about today is the Dave Ramsey. I don't think that Dave Ramsey's a bad guy. Dave Ramsey actually has transformed a lot of people's lives, as we have as a company, but Dave Ramsey's transformed a lot more by preaching financial education to many, many people. So I don't knock what he's doing, but what I do want to talk to you guys about today is why entrepreneurs and real estate investors cannot take the majority of Dave Ramsey's advice. Those of you guys that are out there that have learned some things from Dave Ramsey, I admit, he talks about some great stuff. Doing your personal budgets, having your financial house in order on a personal level, knowing exactly how much it is that it takes to keep your household running on a daily basis. That's all good data. And that's all good data that either an entrepreneur or an employee, anyone can take advantage of. And everyone out there watching should know exactly what their financial house is. Use Ramsey Plus. That's one of his softwares if you guys want to use that to determine what your income and expenses are. We're real estate investors and entrepreneurs listening to Dave Ramsey for advice. That's where it should stop right there, is on personal budgets. As an employee, if that's what you are, and that's okay, great, there's a lot of employees out there, then you should be somewhat risk averse with regards to taking risks. Maybe risk of losing your job, taking risks to lose your financial house, whatever it may be. Entrepreneurs and real estate investors should be less risk averse than people like Dave Ramsey would tell you that you should be. Number one factor, all in, is the difference in debt and Dave Ramsey's understanding of debt. You have debt, Dave Ramsey is going to tell you that you should pay it off as soon as possible, a la the book Life in Air. It's a great book, but it talks all about getting yourself debt-free so you can live on a lot less money and just you can use the majority of your money you have for savings and for enjoyment. All well and good if you're an employee. And yes, if you're an employee, you should focus on paying your home off. You should focus on paying off your credit cards and getting yourself completely out of debt across the board. As an entrepreneur, as a real estate investor, you're going to be more of a student of Robert Kiyosaki, who's going to talk about good debt and bad debt. Good debt is something that you could use to buy an asset. Dave Ramsey only is going to view an asset to be something like a stock or your home. Dave Ramsey, by the way, is going to view your home that you live in as an asset on your personal balance sheet. Robert Kiyosaki, who I would agree with, would view your home as a liability unless it's free and clear. If your home's free and clear, that's something that you could use. That's a personal bank account. That's something you could use to pull a home equity line of credit off of, a HELOC, to go and put to work in your business. A home is a liability to a real estate investor or to an entrepreneur, but an asset to folks like Dave Ramsey, who are going to view it as something in the asset column that you're there to utilize and use for your personal balance sheet for determining your net worth. To a real estate investor, to an entrepreneur, your home is on bad debt because it takes money out of your pocket. An asset puts money in your pocket. Let's talk about things like real estate investments. Let's talk about things like oil and gas, other things that are cash flowing assets. If you take on debt to buy things that are cash flowing and the cash flow they produce are well above and beyond the debt service, that monthly payment that you pay, you're buying a revenue stream. And how great would it be to borrow money to buy a revenue stream? That's the way that the wealthy are doing it. Dave Ramsey would have you write a check out of your own personal pocket to buy the asset free and clear. And yes, that is a slow and steady way to wealth. But entrepreneurs and real estate investors, you're not going to reach the promised land that you want to get to, or you're not going to get to grow as far as you will if you don't take advantage of the magic of good debt. Borrowing money with debt service or monthly payments of this for an asset that has a cash flow of this, so you can keep that delta in between. Right. Dave Ramsey would not like this because you're borrowing debt. And I get that is a risky thing to do, but it's way less risk if you get yourself educated on assets and how assets can produce more than the debt service that they have. Many, many real estate assets, almost all of them, their investments in the world, are owned with some sort of debt on them. So I can't be wrong about this because most investors that are out there, including the big dogs that are out there, are using debt as a leverage vehicle to borrow money at a lower cost than the return on their investment is on the investment vehicle, so they can take advantage of something called leverage. Dave Ramsey calls it risk. Investors and entrepreneurs are going to call that leverage. Two different things depending on the perspective through which you look at it. Next thing about Dave Ramsey that I want to talk about here is his concept of risk. Now, Dave Ramsey would have you be risk averse and save your way to financial freedom. Save up, save up, save up, put money in your IRA, put money away, invest for the long term, put money in the stock market and forget about it. Just invest, invest, invest through passive investments and through paying down debt to reach financial freedom. That is a way to wealth, but that is a slow and steady, take your time, slow growth like this way to wealth. Fine. And as an employee, or someone who is extremely risk adverse, that is a way to get to financial freedom, but you're not going to get there very fast. You might hit there by retirement age, but you're not going to get there to enjoy that wealth building over time. The other way to look at it is to take on more calculated risk. And that's where our opinions differ, is it's okay to take on risk, to make investments and things like that. If you get some financial education, listen to the folks that are out there that are there to teach you about these things, read books on the matter, and become a seasoned investor yourself and take calculated risk on investments that you'd like to make. You are still taking risk, but it's in taking those risks that you can get the reward. Most investments out there that you can make reward more rate of return in exchange for the risk that you are taking. A lot of investments pay 15, 25% on the money, but they're not federally backed. They're not insured by the FDIC or anything like that. Like a CD might be, or something that's a municipal bond or something like that might return 0.5% or 1% on your money. A real estate investment might return 10, 15, 20% because it's deemed to be risky, but the better returns that you can make on investing are in things that the market determines to be risk. Bear in mind, the yield that you make on an investment scales up based on the perceived risk that investment has. But if you can get educated and mitigate that risk and make the right choices, you can enjoy those higher returns while not taking much risk at all because of the education you've gotten. The last thing I want to talk about here, guys, is asset class investing. He talks about bonds and stocks, and he talks about this company or that company, and mutual funds or not mutual funds, or tax leverage investing through IRAs, or taxable investing out of your own pocket. Great. These are all publicly traded investments and they're all liquid on a daily basis, meaning like I can buy Microsoft stock today and sell it in the afternoon, or I can buy it today or sell it tomorrow, whatever it is. I can liquidate that stock very quickly. And you're not diversifying yourself if you buy a Microsoft stock and you also buy Exxon stock and you also buy some BP stock and some Amazon stock. Those are all stocks and they're all traded on a daily basis. What Dave Ramsey missed is investing in asset classes means investing in things that are completely different. Everything I just described are all called securities, right? They're all equity traded on a public marketplace. They can all get traded like this. And if you look at the trends on stocks, a lot of them go follow each other. They're completely different market sectors. And that is because when people panic and they want to go sell their investments, they can do it through E-Trade or whatever there is, their online tools, and sell them all at once. You can't liquidate certain things like real estate investments, like oil and gas, like other things that can't be traded on as quickly. If you really want to diversify, you need to get into asset classes that can't be liquidated at the same time or are not affected on the same trading marketplace that other things are. Dave Ramsey had his blinders on when he recommended for you guys to go and do lots of stock investing, lots of bond investing, investing with the S&P 500, investing on these market indices and things like that. That's all well and good, but those things are liquid. You should have those kinds of investments, but that's not all you should have. Yeah. You can leave it. The S&P returns 8% on average and everything like that. That's all well and good, but it also is one of those things that can go up and go down and go up and go down. You should have things that don't move up and down at the same velocity that investing in the S&P 500 would be, or investing in a stock directly, or a mutual fund would be for that matter. I do have respect for Dave Ramsey, but I also have respect for you. I want you guys to make the right decisions as real estate investors and entrepreneurs, which is why this video was shot to tell you guys all about why you can't listen to most of the advice of Dave Ramsey if you work for yourself or if you're a real estate investor. You guys are more than welcome to argue with me in the comment section below. I'm happy to have a conversation with you. And if you like what I have to say, make sure you smash the subscribe button and like this video. Look forward to hearing from you guys and have a great and profitable week.